Good morning.
Morning.
Good morning. 9:00, 9:30 a.m., July 29th, 2022. I have the honor and privilege of having Mr. Hector Eddie Ramirez, Esquire. Not Esquire. You there?
I am. Good morning.
How you doing, bud?
Great. How are you?
All things are good, man. I cannot complain. Things are really amazing, crazy. Folks at home, everybody that's watching, today what we're talking about is what's going on with the market. Over the last few videos I've done, I've been a little more chicken little than Pollyanna, and Hector has really handed it to me. He said, you know what? We have to have a balanced conversation and debate like adults and discuss what's really going on and look at more of a positive slide of what's going on today. So that's what we're here to do today.
Sounds good.
Yeah. Let's see. Let me get over here. There we go. Fed's raised everything 75 this week. First of all, Heck, give us a little rundown of who you are. Give us like a little elevator talk.
Little elevator.
It looks like you're missing it too.
Name's Hector. Born and raised in San Jose. Been around real estate for a very long time, and been doing mortgage lending here. For about a decade almost here. We're working on. So I do manage a branch in San Jose for Cross Country Mortgage, and that's the short.
Got that extra real excitement there.
We'll warm up a little bit.
Yeah, we're still waking up a bit. My legs are jelly right now, so I'm like post adrenaline right now, so I might teeter off. Today we're going to talk about rates, HELOCs, stocks, etc., and then what we can focus on if you're thinking about selling or buying. So rates went up, or actually the Feds went up 75 basis points, right?
Yeah, another increase this week's Fed meeting. That's two in a row of 75 basis point raise, which is obviously kind of rocking the media. And one of the biggest and what that really is let me just kind of explain that, if that's okay. And so the Federal Reserve, the federal funds rate, which has gone up 75 basis points, this is the rate at which banks exchange money overnight. And the biggest question is kind of like what happened to interest rates, right? I think the biggest fallacy is that most hear this news and they assume that mortgage rates are going up, right? And that's not necessarily true. We'll kind of get into what happened after this Fed's meeting. But when they raise short-term interest rates, what those affect for a consumer is like your credit cards, your auto loans, and your home equity lines of credit, right? And so what really the Fed's doing is they're increasing the cost and access for the consumer for these type of funds, right? And so in essence, they're kind of slowing things down. And really the point of this is to slow down inflation, right? I know you've talked a lot about this, and we're experiencing just really, kind of historic inflation rates, right? Like something we haven't seen in 40 plus years, right? So again, going back to kind of the Fed and what they're doing, their main goal is to hedge and slow down inflation, right? And for the 30-year fixed rate, like going back to mortgages, the arch enemy of a 30-year fixed rate is inflation, right? So as inflation goes up, that's a big reason why we've seen our rates moving up almost the entire year, right? We've had a pretty aggressive raise in rates, probably around 3 percentage points, which is very significant, right? But that is in essence kind of what occurred, right? And so we've had this raise in rates. Now, have rates really changed? Not so much, right? The banks were aware of really what the Fed's intention is. It's no surprise that the Fed rate of return went up. And so really pricing is almost already built in, right, to these changes that are going to occur. Now, what's really interesting is the bond market, which drives interest rates, has reacted really positively, right? So we've actually had a few really good days, and over the last couple months, our rates have actually somewhat improved. So again, kind of just supporting what I'm saying, like, despite the Fed raising rates, it's actually a positive thing for mortgage interest rates.
Right. And we saw in the last day rates go down. Now, home equity line of credits, those HELOCs, they're another story, right?
Yeah, no, they move in direct correlation with the Fed rate of return, right? So if you have money, you've drawn money on a home equity line of credit, there's a very good chance by your next month, next statement, that you're going to see that payment go up.
Right. If you have that home equity line all chilled up, stocks rallied, bonds went up. What do you think is going to happen in the next week?
With respect to what?
To the rates. You think it's going to go up again, or are you going to go back down?
I think we're in a pretty good range. The rates, kind of go up and down, right? We've definitely got a lot of different things happening in the economy in the world, and so there's always room for volatility, right? And it's something we've really been experiencing the last few months, and so super important to be in communication with your loan advisor. Super important to understand kind of where you are, and if you're writing offers, you really want to kind of sharpen it up, make sure you're updating your approval, and make sure you have a strategy for locking, right? We never want to put a client at risk, and in most cases, we really want to kind of take what's there, right? And the moment we get in a contract, we want to quickly assess kind of where we're at, rerun the numbers, and in most cases, the best case scenario is to just lock. And what locking a rate is basically it's protecting you from any volatility in the rate. So typically locks range from 15 to 60 days, right? But our most typical is about a 30-day lock, being that real estate transactions pretty much operate in about 30 days. And so, one of the advantages there is just to be able to lock your rate so that even if they do go up, you are locked into the interest rate that you've been given.
Right. And you're not stuck having to do a 30-year right now. If your heart and soul is saying I need to have that 2% or under 3%, we have those options that are available. I mean, there's a 3-year arm right here, and I'm sure you have something similar. That's going to come with a little bit of a cost, right? There's certain things that we can do to help mitigate all this stuff, and you can actually buy points down too, right? I mean, today's
something common we see, right, which is basically what happens as interest rates rise. It obviously puts pressure and stress on our debt to income, right? And so sometimes, as rates rise, naturally, it could decrease the amount that a borrower can qualify for, right? And when in times like this, when rates are rising, we do see the emergence of different products, just like you mentioned, like an ARM. And some of the benefits, for instance, with an ARM is that your start interest rate is lower than a 30-year fixed. And so it can help a buyer not only qualify for maybe what they were initially approved for, but it also helps them to keep that payment a little bit lower, at least, for the first few years.
And that's important today, because what's happening, not just in the United States, not just in Silicon Valley, but also all across the globe, we're seeing, I won't say a financial crisis, but we're seeing housing crisis all over. Like China's having issues, Canada's having issues. Canada has, they don't have a traditional 30-year mortgage like we do. I just talked to my cousin who lives up there. We had a big conversation about everything. typically what people buy up there are 5 to 7 year arms. And those are subject to rates going up and down, right?
Absolutely. Interest rates being higher in general,
Yeah, and my investor talking about that, my investor mentor, he's saying that there's going to be forced sellers in Canada, and that's kind of the scary thing here. But I can almost tell you, 2 years from now, what's going to happen in November, right? We're in an election cycle. Everything's going to be pressured to come down, no matter what.
Big time, right? Absolutely.
So you buy a 3 or a 5 right now, and you can buy that down even further. And here's some good news, right? We're seeing houses sit on the market a little bit longer. And again, this isn't crashing. The market's not yet, right? We don't know if it's going to or not. But right now, as of today, I show you the numbers every Wednesday. We're seeing a market normalize, right? We're seeing the market get back to what is normal, which is 20 to 30 days here in the Silicon Valley.
What's the average day on the market like locally?
I think we're at 20. Let me check real quick. Days on market is 18. So we're averaging. What we were seeing, days to sell in February, March, and April was an all-time low of 9. And that's just so crazy, right?
That's this past year, just a couple months ago.
Just a few months ago, right? And that's what we're having problems with right now. Sellers like, my house is worth X plus 10. Well, no, it's not. Your house is worth what a buyer is willing to pay for it.
Right. How do you manage those expectations? I know that's something that's challenging with a lot of referral partners that we work with.
It's a difficult thing, right? It's
probably a part of why we've seen a lot of like price reductions. And so how do you manage that, Vito, as a listing agent with a lot of your clients?
Right. I mean, I'm always upfront and candid, saying, "Hey, look, the market." And I've been telling people this. I feel like I'm Chicken Little for the last 2 years. The market's going to come down. I feel like that guy that's in a panic and everybody's running the right way, and I'm that security guy going, "Don't panic," right? But at the same time, I've been proven wrong over and over and over again. And now that the market's flattening out and buyers are like, hey, you know what? It's my turn. You guys have taken advantage of me. I've written 17 offers. I am just so frustrated. There's just no way in hell I'm going to write an offer over the asking price. Right? And that's the mentality of the buyers. And I relay that to the sellers. And they're like, okay, sure. I still want my X plus 10. And I'm like, that was April. That was right here, April, right? February, March, April, the market was still crazy hot. We saw the market exploding down. The absorption rate was at an all-time low, 0.6. That's almost a half a month, right? That was the amount of inventory we had on hand, lasted a half a month. So we're crazy. The absorption rate now is 1.5, which is that last month's reporting. And we are seeing transactions fall through. We are seeing listings get off the market, which is, what we're doing with one of my listings today. We've had the discussion. We've had it on market for 29 days, and the expectation is X plus 10, and the market's just not delivering it. I had 2 offers. I had an offer within 8 days, and it wasn't set to the expectation of the seller. So we're pulling it off the market. We're actually going to do some repairs, make it a little prettier, and wait for the market to rebound. And if it's 6 months or 6 years, we're going to have to figure that out from that point, right? So the market is responding. The buyers are like, hey, I'm just sitting on the fence. I'm going to see what happens.
It's more choices, right? Like they have the ability to be a little bit more picky, which is
right
for a buyer is a good thing.
And they know there's less competition. I've used this graph for the last couple of months now, right? As the market goes up, it's heated competition. When there's a little plateau or a peak, people are like, I don't know what to do. I don't know what to do. There's still houses going into contract, tons of houses going into contract. Pendings, 44 houses, right? That's just San Jose, my specific target of what I'm talking about. This isn't all of Silicon Valley. This is one thing: 3+ bedrooms, under $2 million, 3+, just San Jose proper. So it's not a huge number, but that number was larger, 6 months ago. Everything's kind of slowing down. We are still selling. The markets that aren't hurting right now are the multi-million-dollar markets. I'll show you real quick. This is done by my office manager, former CAR president, Dave Walsh. The last 4 weeks, these are the reporting sales, right? These are ones that go into pending of $3+ million. So there's no shortage of people that are just tossing out that money, going, here you go, just write me a check for $8 million or $7 to $8 million, right? That number is not going to stop. It's not a huge number, but it's going to be consistent. And then when you look at numbers all the way, so this whole chart thing started off of looking at 40 days on market, right? And back when I did this 6 months ago, started looking at this, I'm like, maybe I should put this into a chart. That number of 40-day plus was 28, 29 houses.
Wow.
Now we're at.
How long have you been tracking this? Just the year to date, or just a few months back? This
is just a couple months now that I've been doing this consistently since I started doing these videos weekly. But I've been looking at this number. I had this search up for the last 6 months just to keep an idea. I'm like, holy cow, this number keeps growing. I better start tracking it. And then I'm like, hey, maybe I should talk about it and share it with an audience and see if it makes sense. This is really, boring stuff, but at the same time, it's telling. I'm not saying that the market is not going to crash. If it does crash, I have a sneaky suspicion that what's going to happen is here will be rather insulated, just like we were in 2008, 2009, right? But in like St. Louis or whatever. That's if it crashes, though. I mean, we've talked about this multiple times, right? I'll let you jump in on this if you want.
Rates and recessions.
Yeah.
I mean, I think to kind of like add on to what you're talking, I mean, obviously that's the $1 million question, right? Like what's going to happen to the real estate market? One thing for certain is real estate is directly a result of supply and demand, right? And, looking at the data behind that is really probably the best indicator of what's going to happen with the market, right? The reality is that, the household, the average buyer, there's many more today, right? There's many more households. Construction has been behind since 2008, right? So, and obviously over the last couple of years, during COVID, we saw, with historic low rates, it was just like a grass fire, right? And it just really motivated a lot of people to buy homes and just created this really, for lack of better words, crazy market. And, moving forward, I mean, that's really what we'll continue to monitor is, supply and demand, right?
Yep.
Right now, a lot of the changes that we're seeing are a direct reflection to the rate increase, right? The mortgage rate increase. And, it's just caused a lot of buyers just to slow down a little bit, right? And to assess kind of what's happening and make sure that they're making the right decision by buying right now, you know? And so, a slight pause for some. But one really important point I want to make is that this is the best time to buy since 2018. 2018 was a very similar market, right? And there were some that were speculating at the time saying, "Oh, it's a horrible time to buy," right? And gosh, I know so many people who would love to be able to turn back the clock to 2018 and be able to buy at those prices, right?
Or 2008.
Or 2008, right? And so, Again, I think right now is a tremendous opportunity because the fact that many buyers are kind of on the fence does allow you to go out and really, strike a great deal on a home,
Right.
and not have to pay a premium, And, I mean, as you said earlier, it's like, hey, a house is going to sell for what a buyer's willing to pay, right? The market's going to dictate that. And, you know, today we're able to actually negotiate and get a lot of buyers in, very close to asking price, some below, some above, but very close, right? Rather than have to project and compete against multiple offers and go way over asking price, right? So definitely good opportunity in what we're seeing in today's market for buyers.
Yep. And everybody I'm talking to right now that's on the Pollyanna side, this is what they're saying. Look for homes that are on the market a long time. And what's a long time? Right? It could be 15 days, it could be 150 days, right? I wrote an offer and I knew it was insulting. It was a short sale. It was listed at $1,547,000. And I thought, why not? I'm just going to write an offer. And I wrote it for $600,000 and I pissed off the agent. But what do I have to lose, right? I'm going to start writing offers, like crazy offers.
Do you suggest that for clients?
No, because you're spinning the wheels, right? You need to be really close to where the market is, right? The market has not collapsed. It's not going to collapse anytime soon. So at asking price or a little bit lower, that's okay. But not every seller is ready to do that. Not everybody in their head has understood that or accepted the fact that the market has retracted a little bit. Let's come down to a normal.
Doing that, right? Like exactly what you explained. I think you're kind of more on the aggressive side of that, but I think that's pretty normal right now, where naturally, days on the market are increasing, inventory is increasing, primarily just because we're seeing less pendings, right? And so I think a lot of buyers are doing that, just kind of dipping their toes in the water and getting a feel of what a seller's willing to do, and we've been really successful at negotiating for buyers, price, including credits, and really more favorable terms. In fact, there's been several buyers we've been able to help over the last couple of months that have bought with contingencies, even contingencies to sell their own property, which as you know, was just unheard of the last few years, right? So definitely more leverage for buyers, and really just the opportunity to get into a home at a fairly good price.
This is what I've been telling people, and my buyers are coming out of the woodworks. As you know, I just sent you another one last night, right? I have another one coming. I have an initial call with her coming up here after this video. Buyers are coming out in droves now, right? And my fear, guys, is that, sorry, I'm on the wrong screen here. We might be here. We might be at the lower end. Competition is starting to enter again, right? Everybody's like, okay, so what's the worst that could happen? I wrote an offer and I didn't get it accepted last week, right? If you look at these numbers right here, the number of homes for sale actually decreased by a small margin. But my feeling was, I think people bought on the panic that rates were going to go up and the feds were going to increase the rates, and then interest rates were going to go up, which it didn't. So, that might be a fallout. So right now, I think we're coming into this part right here where more and more competitors are going to start entering the market. So not that I'm telling you to jump in, be aware, understand what your market is, understand what you're talking to, talk with your agent and your loan officer, come up with a strategy and a game plan. Because if you look at the last 30 years of value, just right here, this one right here, right? This is your value. It doesn't matter. I guess that's the same one, right? It's the same chart. This is the one you sent me yesterday. And I use this to too, you're going to see an increase. And we don't know if it's going to be a 15% increase like it has been over the last 2 decades, but you're still going to see an increase in value. It doesn't matter if you lose money tomorrow. So marry the house, not the rate. Somebody says that. Do you say that?
Yeah, it's a funny tagline that we've been kind of hearing through the industry for the last month or so. And the concept with it is basically understanding that eventually rates go down, right? Especially during recessionary periods, especially around presidential elections, right? There's always opportunities to lower your monthly payment, right? And so understanding and maybe even using a different type of loan product to keep that payment low might be a great strategy in the interim to get you into the house and comfortable with the payment. And understanding that down the road, again, there'll be lots of opportunities to lower your interest rate.
Yeah, I have a question from one of our viewers, Mr. Lindsay. I know him well. He's a good guy. I see 15, 20, and 30-year mortgages are on. Are there any 40-year mortgages? And what about interest-only mortgages?
Great question. So yes and yes, right? Those are also two products that have been around for a long, long time, and ones that we see and are, kind of interest, increases for those during higher end, during moments like this when rates are going up. So yes, we are seeing 40-year amortization. So that just means we're spreading payments over 40 years versus 30, right? Keeping that payment lower. Absolutely options with that available, and also interest only, which basically means that an interest only loan is typically a loan that amortizes over 30 years, but over the first 10 years or less, depending on the type of loan, you are just required to pay the interest, right? And so both products that are pretty common and ones that we're getting a lot of questions on these days.
So the 40 years interest only for the first 10 years, and it flips to a 30-year amortized.
It can, or it can just be fixed rate over 40 years, right? So it can have the interest only component to it, or it can just be, a longer length loan. But you can do both actually, and those are really good products. And interest only over 40 years can almost absolutely, maintain you at the same approval letter. There's some approval amount, excuse me. So some really, some really good opportunities with some of those products as well.
Let's talk about hard money. Is that an option? And what is it?
Yeah, absolutely. So private equity money, really what it is they're loan products that, for the most part, have been available for almost like business and investment purposes, right? And what they are is they're really short-term loans, and they're a way to access cash quickly, right? They're mostly equity-based. So when we look at, your general lending, we're looking at the ability to repay, right? We're looking at income, credit, cash. Hard money type loans, they look more on equity of properties, right? And often, we'll cross collateralize a couple properties to be able to leverage the equity in a home, right, to purchase another one. The benefit is again, quick access to cash, right? So it allows a buyer or investor to be able to buy a property basically with cash, right? And the terms of these are definitely short term, so typically 12 to 24 months. And the idea is it's a means to an end, right? It's a way to get in. So it's a way to leverage and be able to buy a property. And then it's important, though, to have an exit strategy, right? And whether it's, you're selling the property or whether you're refinancing the home or property, and making sure that you have a good, solid plan for that to get yourself out of the hard money loan.
So you convince, or you don't convince, you strategize, you have a complete plan of entry, how to use it the best, understand what the costs are, because it's a little bit higher. I mean, but it's there for that as a tool. And then you have an exit plan when you're discussing with them, right?
Exactly. And we've heard like the, it's become a really hot topic, like bridge loans, hard money loans. They're much the same, and we've heard a lot more of them in the last few years. And the reason why is because the supply was so tight and our market was so hot that it really, it was impossible to buy with the contingency of selling your home first, right? And so that's, by way of a lot of products, I know we've talked about kind of like buy before sell, right? Buy before sell strategies that we deploy here in the Bay Area to help so many buyers during the really, during the really hot market, right? And so we saw the emergence of, kind of bridge loans, which are in essence hard money, used on the residential side to help buyers be able to basically go all in, buy as cash, right? Just to land the home, and then obviously be able to turn around, potentially sell their property or refinance that home to the terms that they kind of initially, set out to have.
Right. And it's a good stopgap, right? Because there's always options to get people into a loan, no matter, if you have like less than a 500 credit and zero reserves and no money down, you're not going to be a home buyer. But you also, if you have decent credit and have the money to back it up, you're a good risk. And if you have a home to collateralize, then you move it over, right? We were talking about using that as a strategy for my group to buy homes and flip it. And while I have to understand the total costs, that's like majorly intriguing to me, because buying a house, rehabbing it, I have to have that cash flow going, and then there's no money coming in. And my intention is to have long-term rentals, and that would be just a good thing for me to have to funnel through, right? So I don't have to go back and forth. So
it's like having cash readily available, right? It's kind of like, it's almost like a line of credit, right? Where you have the ability to draw on this money and fund a loan, in a week, right? 7 to 10 days, depending on the, maybe quicker, maybe a couple of days, somewhere in that timeline, right? Or really the ability to quickly be able to close a transaction. And it's powerful, and it's really important on the, kind of on the investor investment side of things, right? And absolutely right. Like, you definitely want to plan it out and make sure that you have enough assets to potentially cover that short-term loan, your rehabs, and all the costs and hidden costs that can come up during, a renovation or purchase.
Right. And, this is an important understanding of what we're doing. And, to all the agents out there, we're a major part of the U.S. GDP, right? If you look at the next couple slides, and I'm going to come back to this thing, real estate and finance is a huge portion when it comes to our GDP. With everything else involved, it's finance, obviously money, but there's also real estate and all that other stuff that belongs to it. We're one of the most important sectors that are keeping the economy going right now. So it's important for Powell to keep rates right and inflation at bay. And I don't know if this next 0.75, the ones that just went up, I don't know if that's going to be enough. Because if you look historically, right, you look at what Volcker did back in the 70s, he ripped off the Band-Aid and put that fire out of control fire into control. And that's what a lot of skeptics are saying about what Volcker did, or Powell did. He should have just went up to the full point that everybody was talking about to cool inflation. It would have struck us down a little bit. It would have hurt our GDP. It would have hurt our industry a little bit. But at the same time, I think it's something that we needed to have happen.
It's a fine line there, right? Because obviously, when you're slowing things down and making it less attractive, for consumers to leverage available credit, it's going to slow down the market, right? So it's a really fine line there between obviously controlling inflation, but then also kicking us into a recession.
Right. And we want to keep that balance so we don't do that.
I think Mr. Powell, he kind of addressed them that they're going to watch it very carefully. because they do want to be, they do want to be cognitive of not also putting us in, just shifting everything over and potentially putting the U.S. economy in a worse position. So
Right.
I think over the next month or two, prior to the next meeting, I think those are some things that they're going to really be paying close attention to as well. That's really kind of what they do, right? They do an action, and then they kind of monitor over the next month or two to see, okay, what type of reaction, do they get from it?
Right. So if you're looking at what the next catalyst, I guess, the next indicator is, and I heard it today at the gym, there were a couple guys yapping, a couple young guys yapping about being laid off. And one guy was like, yeah, I'm okay. I'll be okay. I knew this might happen. So, but I think that's like going to be the next trigger to,
absolutely.
Yeah, I mean,
and the government and the White House alike, that they feel that employment's been really strong. They're in a little bit of denial, right? Our consumer price index numbers came out yesterday, and that's the second quarter in a row of negative GDP,
which means it is a recession.
That's pretty cool definition of a recession, right? It's a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP for 2 consecutive quarters. So,
yep. And now they're trying to restructure that definition,
right?
for midterm elections. I don't know what's going on. I don't care. But guys, it's, I mean, technically we're in a recession. How bad it's going to be, it doesn't really matter. But then you look back at these numbers here.
Well, it's interesting, right? This is this is a really interesting graph, because obviously when, it's like, okay, us as a buyer, we have the ability to buy now, not going way over, right? Okay, like interest rates are rising, so date the rate, like get comfortable with the monthly payment, find new loan options to be able to kind of deal with it. But moving forward, then you have another set of fears, right? Like with a recession and what's going to happen, and how's it going to affect, real estate, right? And so this is a really cool graph, because what it shows is the dark kind of vertical bars there. Those are the last, 6 recessions, including COVID, right? The last 6 recessions. And as you can see, in every single recession, what happened to mortgage rates?
They went down. But they had to go up a little bit to smack the economy around. This is Volcker's time. And then this was Reagan time. Yeah. And then this was Clinton, and then Bush, Obama. No, this was Clinton, Bush, and then this is Obama. Or Bush, Obama. And then this is just the last couple. That was 2018 was more like a blip, right? I mean, it only happened for like 3 months.
Yeah, it was mostly 2020, I think,
Yeah.
But I mean, we saw that we obviously saw rates trend into historic lows,
Right.
The last, almost the last 2 years.
What was the lowest loan you wrote? The lowest rate?
We were probably did some loans in the low 2s,
like 2.25 ish.
Right in that range. I mean, I had some buyers that had appetites for buying down rate.
Right.
Some buyers that are later in their life, we were looking at, okay, shorter term loans, right, which tend to price better. But we saw the 30-year fix. I mean, dancing in that 2.5% range, give or take. And I don't think personally that I closed one below 2%. I know some were done, but we're awfully close, which is just insane.
Those people are going to be in those houses for a very long time. It would be foolish for right? I mean, they're basically off the market for the next 60 years until they pass away, or they get divorced, or whatever. I mean, it's stupid for them to even sell it because of that rate being so low.
Yeah, I'm not sure if we'll ever see rates that low.
I think the only reason why I went that low is to keep the economy moving, right?
Of course, it's really because of the Fed buying mortgage-backed securities, right? And so they really do control the market, and that's that particular action is really how they I don't know if manipulate's the right word, but how they can help lower interest rates, right? Is them just coming back in and buying mortgage bonds, which they were doing at just an alarming rate during COVID.
Right.
Yeah, this is a really interesting graph also as it relates to real estate because it shows really the average price of the home, again, during recessionary periods. And again, those vertical bars are the last, I don't know how many recessions there are, 8 maybe more than that, 5, 9 recessions, right? Going back to 1960. And as we can see in every single one, except one recession, housing prices leveled or went up or continued to kind of rise, right?
Right.
Every single one, home prices leveled off or rose at a kind of slower rate though. The only time that it didn't was in 2008 2009 during the housing crisis.
But that's because of the housing and the toxic assets that we as an industry put together, and they were selling them off on the market as AAA or whatever rated thing. It was just a bad mess.
Really junk loans. I mean, a lot of things have changed since then, right? It's probably ammunition for another really good live, but yeah, much different market than we're seeing today. A tremendous amount of inventory, really loose lending guidelines. There's just a lot of things that contributed to that. Much different from what we're seeing today.
Yep. So, if you were to buy a house today, Hector, how would you ask your awesome agent to write that offer?
In what sense? I mean, I think one of the important things is the other way around, is really to work with someone who really understands it and to really listen to what agents are advising, right? I mean, I think that's a lot of the frustrations that I'm hearing from agents with their sellers, right? Where they just, sellers are so hard up to sell at a certain price that they're not really potentially listening to what the agent's advising. I think that though in writing an offer, you still want to kind of do the same thing. You want to do comparative market analysis. You want to understand, in a very short term, how other homes have sold in the area. You really want to make sure that you're working with your lender to approve, to rerun your numbers and make sure that you're comfortable with the payment. Right. I know for my buyers, I want them to know exactly how much they're going to spend on a monthly basis when they're writing offers. Right. Not only because one, I don't want them to have a knee-jerk reaction or feel some type of way after the fact. And two, also so that they know how much room they may have to negotiate, right? And what they may be able to potentially, concede or move up from, and where their limitations are. A lot of it really comes back to a monthly payment, right? Because that's what you have to stare at on a monthly basis.
Yep. And what we're writing right now, we actually wrote one a while back last week. We came in a little bit lower. We asked the seller to pay for closing costs, etc. Back in the day, so many months ago in April, it was expected that you gave the seller 2 months free rent back. And that was just so painful. It's so painful. As a matter of fact, right now I have a seller that's waiting for their deposit check to come back, and the buyer's playing stupid games. So they're going to take him to small claims court. Oh, I never liked doing the whole rent back thing. I hated it. But it's a thing, right? I mean, it's something that was expected. People heard about it, so they're expecting about it. I never really mentioned it. My thought is you sold the house, get the hell out, right? When I sell this house, I'm out, right? I'm not even going to move my stuff. I'm giving it away, selling it, or burning it in our park. I
It
don't
comes
care,
as is.
right?
It's all yours.
Yeah. It's like, I'm going to be like, hey, do you want this? Whatever, just take it, please. Because the only things
Who
that mean,
wants to have to move stuff, right?
no, I don't want to move anything. I'm going to give all my clothes away because I mean,
Just leave it all where it is.
my couches have been destroyed by my kids and my dog. So why would I want to traipse that across wherever I'm going, right? To another country or something.
Leave it behind.
The only thing I'm keeping is my kids' first shoes. That's all that I care about. Everything else, I don't care. So even all that wine that I don't drink anymore. So, but when you write an offer, you can expect to ask the buyer to pay closing costs and buy down points and, ask for repairs. Those are normal things in a normal market. Those are typical. Like when you're a VA, when you're buying a VA or buying a house through a VA loan, you're not allowed to affect any repairs. You're not allowed to pay for any repairs. And you have to have the house, inspected to a specific habitable condition, meaning it has to have Section 1 clearance. It can't have any holes in the floor. The heater and air conditioning, all the appliances have to run. That kind of stuff.
Health and safety stuff, really, right? I mean,
right.
VA loan's the best loan out there. There's a lot of perceptions that it's really a lot harder than it is, and it's really not. These safeguards are put in place for veterans, right, to make sure that they're not getting into a home that has a bunch of problems or issues. Really not much different than a regular purchase. But again, like you said, there are certain things that we do have to have clearance on. One of the great things is they don't have to be done prior to the close of the transaction, right? That's something that changed during COVID. And as a result of the market, we are getting more veterans in. So definitely a positive thing.
It's important that we house our veterans, it's, and if you're an employer, take care of them, regardless if you thought that the last 20 years was worthwhile or not, they did sign up to protect our country. So
during all the holidays, we all post stuff and say stuff and wear, our red or our camo or what have you. And everyone wants to thank those who served and continue to serve. And one of the best ways that we can give back is to accept a VA offer, right?
Wow. Who's that young guy? Back in my day.
Is that Rambo?
Sorry. I had a little giddy moment there. That was my legs recuperating. All that lactic acid went down to my legs. So guys, if you're in a mode to buy and sell, remember I've talked about this a few times. I know we kind of segued. There's less competition right now, right? I don't know if we're in this peak or this peak or this peak. It doesn't really matter. We're at a peak right now where sales have slowed down. The difference is huge for you. Hector, you mentioned it before. You can actually write a contingency to sell your house. Contingencies are awesome to have to protect you as a consumer, right? Because it was so competitive, we got rid of most of our contingencies, and my brokers were harping on us, stop writing offers without contingencies. But you can't get a house accepted unless you write zero contingencies. Now that the market slowed down, you have full authority to ask to protect yourself in that purchase contract. There's 4 different contingencies you can ask for: loan and appraisal, property condition, and the need to sell your house. If you have to sell and move in a hot market, it's much more difficult. If you buy and sell in a cool market, yeah, you're not going to get a high price. That's ego, right? Don't worry about the ego. Don't worry about that sales price. You move And yes, you know what? We make less money, but that's okay because it's less competition. You can buy a larger house. You can buy a house for less money. You can go underneath the house, the list price. There's less competition. You don't have to pay that premium of $100,000 to $300,000 over, right? The record in Santa Clara County for list price over sales price was $2,107,000.
Wow.
Stupid.
Yeah, my personal highest was earlier this year, and we had a buyer that really loved this home in Cupertino, and we offered 1.1 million over asking. We probably were at about $1 million over, and then kind of negotiated up a bit, kind of as far as our buyer was willing to go, and the house ended up selling, I think, for about 3.45. It's listed at 2.388, I believe.
So that's like 50% over.
It's crazy, right?
It is. Yeah, it's crazy. Well, guys, you don't have to do that anymore, right? I mean, not now. When competition comes back in, more competition means you're going to have to start getting rid of the contingency, or losing the contingencies, upping the price, right? But Hector, what happens if the market continues to go down? It doesn't matter, right? You bought the house. In 10 years, it doesn't matter, right?
Of course not. Listen, markets are going to go up and go down, right? So the important is to really plan this correctly. If you're buying a home for a primary purpose, then what's most important is that your payment's fixed over time, which it will be. And it really that makes no difference if even if prices go down for a bit, right? Because you're in it for the long run. And we know, looking at data, that over time, your home is probably the safest investment out there, and even over the next few years, our appreciation estimates have reduced a little bit, right? But even with that, like, we're still expecting nationally to be appreciating from like 3 to 5%. It means that every month and every year, your home is still gaining value. It doesn't feel like it because the last couple of years, homes have been increasing over double digits, right? Like, just unrealistic amounts,
Ridiculous.
right? So, and like going back to like normalcy, like, yeah, it doesn't feel like it's getting value, but it absolutely is, right? And that's just a benefit of ownership, that, it's a built-in savings account. You're paying your mortgage every month, right? A portion is going towards your principal, which means you're reducing the amount that you owe. At the same time, your home is slowly gaining value every month and year over year. And so you're building equity in that home. And, that will always stay constant, right? And is the biggest reason why we, advocate to buy today.
Right.
If it makes sense and you qualify, programs are available, you're comfortable with all the terms that you've been quoted, then absolutely, work closely with your agent and make it happen.
Right. It's a crazy time, right? And there's a lot of speculation, a lot of stuff going on, and I hate to besmirch other younger agents or less experienced agents, but we know what's going to happen in the market. We know how to work through all these things, and maybe you're on a team or what have you, but I've been doing this. You've been in the business a lot longer, right? You said 10 years.
After the last recession, actually. So I really, licensed in 2012, and I really didn't get active till about 2014, where I kind of really committed to
ate the applesauce.
Yeah, exactly, right. So I kind of started in real estate, about almost 20 years ago, and kind of just around investments and doing different things like that. To really just kind of learn it. At that time, we had a really strong market, and it was intriguing, and I was out of school, and we just kind of did, some stuff around real estate. Went away, kind of, did some sales, and utilized my marketing and finance background, and then found my way back into the real estate and mortgage business. And like one of my biggest whys coming back in the industry is that I had a lot of family and friends that quite honestly lost out during the mortgage meltdown, right? And part of my why in coming back was to be able to do it the right way, right? To be able to give buyers and consumers solid advice, right? And really to be able to help them mortgage plan to allow them to build, to buy and to build wealth over time, And so I've really been in the business through a tremendous upswing,
Right.
But as part of that, over the last, especially 8 years, we've seen very, very similar, similar things that occur in the market, right? And so, a lot of the things we're seeing now, we were seeing them in 2015 and 2016 and 2018 again, right? And so, just have to kind of jog our memory and get used to working and talking about those same things with our clients.
Yeah, and that's the great thing about working with you. You understand the market. You understand how to coach people from a 500-foot level, right? You're not in it for the commission. You're in it to strategize along the line. And you've told me this over the years that we've known each other. You're here to strategize, and if they go somewhere else, that's fine. They'll come back to you because you understand the strategy, you understand the fixation. And if those people that are like rate motivated and they miss out on an eighth of a point, they don't come back to you, they're lost, right? You're there to help them grow wealth over time.
Exactly. I mean, rate is really important. It's a financial decision, right? And obviously the way we're structured, we can absolutely compete with any product type, right? But the consumer and the fallacy, like even with realtors, is that everything's so rate centric, right? Everything's is about that, right? And while it's important, it's really just one piece of the puzzle, right? It's just part of it. And some focus, and it's good to focus really on payment, right? Focus on how much you want to put down and how much you want to pay a month, right? And then build out from there. And I think one of the things that I've learned that works really well with consumers is to give them options, right? A lot of times I have clients go, well, what would you do, right? And with a lot of options in real estate, it's not that one's bad and one's good, but one is better, right? And typically one is better for you as a consumer, right? And so, one of the things that in the way that we utilize tools to be able to provide options for clients is to give them a lot of different options and help them understand, potentially what's the difference between maybe an FHA loan and a conventional loan, or what might be, or is it more advantageous to, wait 2 years and save 20%, or get into a program today that only allows you to put 10% down, right? What are the opportunity costs in waiting? What are the benefits, right? Same with, I kind of lost my train of thought, but just looking at options, right? To understand what are the best options for you, right? That's my job as an advisor, is to give you those. And if I've done a really effective job with that, then it makes it much easier for you as a buyer, a consumer, to make the right decision.
Right. I know I've seen it multiple times with you and our clients, where you give them options and they have, a 5-year, 10-year, and then a 30-year. And then if you buy rates down, you have all these different options. It sounds like it might be confusing, but not the way you deliver it on your video spreadsheet.
Yeah, it can be really confusing, even if you've done this multiple times, right? Things change, guidelines, products, everything changes, right? And so, honestly, I always like to have an initial buyer consultation like this, right? A lot of it you see face to face, many now are over Zoom. And even if we bought multiple properties, right, it's always good to kind of get back to the basis, go over, the current marketplace, and kind of revisit the whole process, and then really set our clients up for success. I mean, many times, and I think one of my biggest pet peeves So one of my biggest pet peeves as a lender, and one of the biggest mistakes, I should say, the biggest mistake that buyers make today is that they wait too long to get approved. They wait too long to get approved, right? Finance, mortgage side is really, it's really boring, right? But it's really important, right? It's probably the most important part. And many buyers, obviously it's super fun to look at houses, even look online. And most buyers wait till they find a house and get really, emotional and really excited over it. And then they run and go find financing, right? And so it's like we rush the most important part, right? And so it really limits, your loan advisor to be able to kind of set you up and walk you down a path for success, right? And just opens the possibilities of errors. And it really, doesn't necessarily give us enough time to mortgage plan correctly. So I suggest, not sorry to jump back in, but so I suggest always give yourself like at least a week or two to allow your lender to approve you and give you options and really make sure that approval is solid. In most cases, you really want to be fully underwritten, so that you're going into the home buying process really aware of where you stand.
I 100% agree. And one of the first things, I know I have to have you come in and do some other classes in this, but I actually have an entire home buying course. And I know, yes, we're going to call you and bug you and tell you to work with us, but at the same time, this is free, right? It walks you through the entire process. We spend the most amount of time understanding finance and why it's important and how to work with it and how to negotiate and figure out what's going on. So I just put it inside the comments. I'm going to have it in the description as well. If you're watching this and you want to go through a free course on how to buy a house, it's easy read. It'll take you maybe 20, 30 minutes to get through it. And at the end of the day, it's going to help you get that much further ahead to when you start working with Hector and Vito.
Yeah, absolutely. It's never too early to start planning the purchase of a home. It's never too early. That's another thing. I always say, I'm working towards it, right? I'm working towards buying a home, right? I'm fixing my credit. I'm saving money down. It's like, imagine a goal, any goal, to set a goal for something, but really not understand the steps to get there. Like, how successful would you be, right? How much longer would it take if you didn't have a clear path? And I think that's, a reason to be in touch with an advisor today, right? With a loan advisor that can walk you down those steps and give you a solid plan to get you to buy. Honestly, with a little discipline, anyone can buy, but it just takes the planning, right? And credit can be a mystery. Understanding really what you need specifically to buy can also be if you're not talking to kind of a loan expert, right? So advise even if you're looking to buy next year, right? Now's the time to start having these conversations to understand what are some steps that you can even take on your own to prepare you to buy.
And this is a great time to use that slide that I made for you. Boink. Look at that pretty new face. How young were you there?
It wasn't that long ago, believe it or not, but it was many, many pounds ago, right?
It was COVID 40.
Having kids really kind of did a number.
Yeah.
I'm hoping here now in my mid 40s to get back to a little better shape for sure. That's
You're always welcome to visit us at the gym, buddy.
I had a birthday earlier this month, and that was one of my goals. Happy to be kind of where I'm at, but definitely a goal is to focus back on the health, and health is wealth. And we've learned that through kind of what we've been going through the last couple of years, and fortunately been healthy, but definitely need to start allocating more time at doing, being outdoors and doing fitness. All
right, dude. Hey, stick around. I'm going to do an outro, and then we'll see everybody. I'll see you on the back end.
It's good, man. I appreciate it. It's great to kind of collaborate with you. Always motivated and always have the ability to help people, and so definitely always appreciate having me on and being able to talk about some really good stuff.
All right, man. I'll see you on the backside. Everybody, thanks for watching. I know this was a little long, but there's a lot of great information here. I hope you found it useful. If you have any comments, please write them down below and I'll get back to you, and please subscribe. I'm Vito Scarnecchia with the Abitano Group, powered by Compass. We'll see you out there.
See ya.